It's never too early to start thinking about financial independence or retirement and how you're going to manage your money in that type of situation. If you're close to retirement, particularly very important, or if you're in retirement, obviously it's very, very important too. And a really classic and good way of doing that is what's called the buckets of money approach. Pretty proven approach developed by Ray Lucia many years ago. But the environment we're living in right now, the investing environment right now, is real challenging as far as making that approach work. So it'll still work, but there's some things you want to be aware of as well too. So we're going to talk about buckets of money and how you can use it to help manage and fund your retirement. Coming up. Hello and welcome to the channel where we help you to learn fast so you can become a confident and successful investor. If that type of information is interesting to you, hey, I'd love if you consider subscribing. Okay, so let's talk about the buckets of money approach as far as a way of managing money. And it's very, very successful. I've used it in a lot of ways or tweaked it a little bit. And right now, if you read a lot of articles around it, there's a lot of negative articles saying, it doesn't work anymore. And I think that's going a little too far, but there's definitely some things you got to be aware of. So let's talk about this approach and help you to make sense of how to actually implement it and also what are some of the challenges we're facing today with it to see if it's a right fit for you. So, all right, so let's get started and first start talking about buckets. And the classic way of thinking about it is you have three buckets you place your money in. Instead of one big bucket where all your money's, let's say, in a savings account, you have your money in three different buckets, again, to help manage it as you're close or in retirement. You have a short-term bucket, a medium-term bucket, and a long-term bucket. Basically, these are three different accounts or types of investments or assets that you're putting in these different buckets. And we're going to talk about that in a second. What you put in each bucket. But each bucket kind of works together too. So when we talk about the short-term bucket, we're thinking about money that you're going to need either right now to help finance your retirement actually, or in the next 1 to 3 years, right? So this is short-term investments, very safe investments that don't have a lot of volatility. By volatility, I mean going up in price or down in price. We want it to be very kind of stable type things because in the short term, you're going to need the money as the idea as far as funding your retirement, buying things, going on trips and buying fun things like food, for example. The next bucket is the medium-term bucket, which is 3 to 10 years. It's kind of in between. And then long-term is the 10 plus years. So that's something you're not going to need for over 10 years. And each bucket has different things in it. So if we look at it, in your short-term bucket, that's where you're going to have cash, right? You're going to have cash that's really low interest rate, not really great interest rate, just kind of is there for spending, right? And it's very, very safe. You're going to have, the classic way of doing it is like having 3 years worth of cash. So no matter what the stock market's doing or other markets are doing, the bond market, when they're going up or down or whatever, for 3 years, you've got your living expenses covered and you're set. So when we talk about that for 3 years, you also want to think about how much you spend each year and kind of budget around that and then set aside enough cash in this method to cover yourself for those 3 years. And whether you're using buckets of money method or other methods, having emergency funds and having an amount of cash set aside to weather the stormy weather up and down is important anyways. And that's where the short-term bucket comes in. The next is the medium-term bucket. And this is where you're going to put some things like bonds. They're not as volatile as, let's say, stocks or other types of things, but you're going to have bonds, which are a little safer, maybe in balanced funds, where you have some bonds and maybe a little bit of stocks, but it's mostly bonds. And this is that 3 to 10 year bucket where you basically have things that are a little more risky than cash, but not as risky on the longer term or the growth oriented stuff, which would be like stocks, for example. So it's kind of in between. And the idea is they're going to give you a better return than what you would get for cash, better money growth on that. So and because you don't need it for 3 to 10 years, you have time for it to grow and you have time for it to weather if there's any little ups and downs along that. But it's still less volatile than your longer term one. That's why it's looking at classically at bonds and balance funds. And then the last bucket is the long-term bucket. That's 10 plus years. That's where you're not going to need that money for quite a long time. And that's where you put in things like stocks and high yield bonds. So stocks, you have the stock market, right? And stocks will give you the best return over time. On average, they're around 10% as far as a return. Comparing that to, let's say, bonds, that might be in the 6 to 7% range, depending what type of bond you're looking at. Traditionally, again, in lower interest rates, bonds will return a little less. And then cash, which is usually around from 1 to 3% historically, though we're once again living in a very low interest rate environment right now, so something to be aware of. But the idea of the long term is it's going to help help really grow and accelerate where you're spending down your short-term stuff. Your long-term is going to grow to help fund these other buckets later on is the idea. And we're going to demonstrate that in a second. So that's where you have things like stocks that can grow, at this faster rate than your other types of investments in the short-term and medium-term bucket. I mentioned also high-yield bonds, and high-yield bonds is actually our bonds actually. So there are bonds like other bonds, like government bonds or company bonds, but high-yield bonds are bonds from companies that are struggling, right? They need to raise money, and they're not a good risk investment. So if you're investing in something that's a little bit more risky, like the stock market, or something that's risky, like buying a bond from a company that's struggling a little bit, you're going to want to get a better return on that. You want to get a better interest rate on that. So when companies that have low credit ratings, you might see things like, oh, their credit rating was downgrade from A to B or something like that. So that's a downgrade, and that's where they're talking about the rating of bonds. And as bond ratings on a company go down, they have to pay you, the investor, more to invest in their bonds. And that's where high yield bonds come in. They're basically high yields or high payments, high interest or no payments too. So you make more money on holding the bond. Now the risk is you can go down too, much more volatile, and possibly a company could go bankrupt and then your bonds are essentially worthless, right? So much more risk in it, but you'll have a better return. And again, they're better for, like, if you're investing in a high yield, like exchange traded fund or mutual fund, you have that longer term horizon where the mutual fund might buy a whole bunch of company bonds, and then they mitigate that risk by having, let's say, 100 companies in there versus you trying to buy one corporate bond is a way to do it. And then if the bonds go up and down prices, they're very sensitive to interest rates, for example, going up or down. These high yield bonds can weather that storm better. That's why it's in the longer term 10 plus growth years. Also, high yield bonds react kind of like the stock market. So when the stock market's up, traditionally, it can vary of course, but traditionally high yield bonds would go in the same direction. Vice versa, traditionally, and this can change of course, nothing's perfect, but traditionally regular bonds go down when the stock market's going up. So, and vice versa. Bonds are better in going up when the stock market's going down. So that's the traditional way to look at it. The exception is high yield bonds will tend to follow the stock market, whether up or down. Another thing about high yield bonds too, a lot of people get freaked out about it. I've owned high yield bonds most of my life as part of an overall portfolio and having some diversification. But high yield bonds are also known as junk bonds. So if you want to get scared off of high yield bonds, if you've heard about, oh my gosh, junk bonds, remember back in the 70s, 1970s, there was a whole scandal around that, and there were some scandals in the 70s and 80s, but that's basically, what they are is they're basically bonds from companies that are much more risky. All right, so we have our three buckets, short-term, medium-term, and long-term, and in each bucket we're putting, a different amount of money in there. And you spread out your money, your first 3 years cash is covering your expenses, and then you're breaking up your medium and long-term. And you could have those be, the rest of the money could be 50-50, or maybe you want more in longer term, a little bit less in medium term might be the way to go. All depends on how soon you might need stuff is the idea behind that. So now that we've talked a little bit about what assets are in there, what does it go for? What is it being used for? And as we really kind of mentioned a lot, the short term is all about the living expenses. That's really all it's doing is covering living expenses. That's what it's for. It's not going to get you much growth or return on your interest rates, very low interest rates on cash accounts and certificate of pocket deposits, money markets. So it really covers your living expenses. Medium term is like giving some extra income stream there for you to help, help fund the short term one and help grow, get some modest growth, and really want to protect you from inflation. Inflation being prices going up, right? So inflation is when prices rise. And so typically inflation runs around 2% or so. It can be varies by country and situation, but you want some bonds that are at least going to return better than, let's say, inflation or better than 2%. And they do typically 6 to 7%. And the longer term is your growth, right? That's stuff you're not going to touch for 10 years or more. And that's going to really be your growth method from the buckets of money perspective. So it makes sense, right? So far we're breaking up our buckets, and then the buckets work together in terms of they start feeding each other. That's the interesting part. So with our short term, well, how do we refill that bucket, right? So we refill that bucket by taking, once we've gone through our 3 years, or it's a rolling 3 years, so once we've gone through 1 year of living expenses, and now we've got years 2 and 3 left, we need to fill it in again to get it back up to a third year. And we take that from the medium term 3 to 10 year bucket. So then we're moving money out of that bucket, in this case, the green bucket into the red bucket, because we're generating income in that bucket and generating profits from there. So each year, as you spend down in your short term, you're moving money from your green long-term bucket. And then the other way, then what happens after, as part of this too, is how do you refill your medium-term bucket? Well, that's where your long-term growth comes up. So as your medium-term bucket goes down in value, because you're moving to short-term, you start refilling that with long-term. And the idea is that your long-term bucket, you're going to have enough money to outlast your costs or outlast your living expenses. But it's a way of breaking it up so that you can get growth while you're either near or in retirement, as opposed to putting everything in one short-term bucket and not getting a good return and low interest rates, not keeping up with inflation in your short-term bucket as prices rise. And then that's where, a recipe for running out of money. So splitting it up gives you an idea or an advantage of diversification and different types of timelines around for these different buckets to help you be able to manage your money in retirement more. So buckets of money is a good process, a good way that works as far as understanding and how to kind of set it up, and then letting your investments kind of work for you, and you kind of monitor them and rebalance as necessary, and then fill each of the different buckets. But there are some challenges right now, as I mentioned, that we're living in today. So let's talk about that a little bit. Oh, and I should mention too that there is a fourth bucket option where you take your 1 to 3 short-term bucket and you create a fourth bucket ahead of that called the now bucket. So that's 0 to 1 year, and that's strictly just in cash. And then in 2 years, 2 and 3, maybe put something a little bit more, still cash oriented, but maybe a little bit more risky, maybe a little like a small short-term certificate deposit, and you kind of have those, come due every year. So you're constantly refilling that part too. So you can split up that 1 to 3 year or 0 to 3 year bucket by adding a fourth bucket. 0 to 1, 2 to 3, 3 to 10 would be your medium term, then 10 plus would be your long term. So you can do that too as well. So the challenge that we are talking about here is related to interest rates and inflation. So right now we're in an environment where there are very, very low interest rates. Historical low interest rates are very low interest rates, which means in your more short and medium term investments, your cash and your bonds, they're not really returning much as far as profits for you by just holding it. I mean, you got interest rates in cash that are below 1%. I mean, it's really a tough environment. And that's coupled with inflation, which is always rising. There are periods of where it goes down, I guess, deflation, which has its own problems, but typically inflation will rise about 2% each year. Sometimes inflation runs a little bit higher than that. In fact, when I'm filming this video, we're in a little period of inflation rising a little faster than that, and that's a real concern. So if you have your short-term and medium-term buckets not getting much returns in terms of interest rates, and you have inflation rising, and your bonds and your cash can't keep up with inflation, very common for cash to not keep up with inflation, but if your bonds aren't even keeping up with inflation, well, then your spending power keeps going down. I mean, you still need to buy food, you still want to travel, you still want to do all these different things, maybe buy a new automobile or pay for extra things around healthcare, whatever it may be. And if costs are rising too fast, it's hard for those short and medium term buckets to keep up. Your long-term bucket might keep up, or should keep up, because that's your higher end growth stuff. But it causes a little bit of a squeeze on the shorter end, because you need, especially that medium-term bucket, to last 3 to 10 years. And if it doesn't, if it's only lasting 3 to 5 years, well, that's messing up the whole strategy. You have to take on more risk than possibly. So let's talk about some of the things you can do in an environment where the interest rates are low and inflation is rising. What are some options that you can do? And let me tell you, none of them are terrific options, by the way. But let's talk about some of the things that you can do. Well, first off, one of the things you could do is like win the lottery or get a big inheritance. That would be helpful, winning the lottery, I guess. So you can't really plan on winning the lottery. If we did, I would have suggested winning the lottery years ago. So we have to do some actually real world stuff. And really one of the things that you would do, and really what everything kind of orientates around, is taking on more risk. We try to keep it very risk averse in our first and our second bucket, but maybe you need to take on a little bit more risk in those types of buckets, particularly your second bucket. So maybe you're looking at some more riskier assets, like adding more to the stock part, the last part. Maybe you're going to grow that to be a bigger part of your holdings, or you're going to put more money in stocks, or you're going to start, adding some stocks, maybe a little bit into that middle bucket to try to take on more risk and get you a better return. One thing that's out there is what's called a sequence of returns risk, which is, basically things going down in value, the stock market, for example, going down in value right when you retire. And so that, that sequence of when you're pulling money out and the returns can be a little risk around that. So just be aware of that too. But you run with the bucket of mice thing, but if you're projecting out, it doesn't seem to be helping you get to your full life expense, so you might need to take on more risk. The other thing you can do too is leveraging better income generators. So our cash bucket is not going, in short term, is not going to generate much income or much interest. A little bit, but not much. It's that middle bucket is a big income generator, and the growth is in the last bucket. So what you can do in that middle bucket is add things that generate more income with a little bit more risk, but they generate more income than, let's say, just bonds by themselves. One of those is stocks, which is dividend stocks. There are some stocks, not all stocks, but some stocks that pay you a dividend, as in every quarter you get paid money just to hold the stock. So I have all sorts of guides and courses and all sorts of stuff around investing in dividend stocks, so take a look at those. But the idea is that we're going to take on a little more risk with the stock market, but we're going to mitigate that a little bit and reduce a little bit by having it pay us a dividend every quarter, and we're going to use that income to feed and help fund our short-term bucket as the time goes by. So you can add dividend stocks. You can also add other types of alternative investments that pay out some income like dividends, like the dividend stocks do. Two that really stand out to take a look at is REITs and MLPs. So REITs are real estate investment trusts, REIT, R-E-I-T. If you search R-E-I-T, you'll find them. Real estate investment trusts. I got a course also on REITs and MLPs too, as far as owning real estate without actually buying property. And that's the idea behind that course and behind the idea of REITs is you don't have to buy property, come up with a bunch of money, put money down to buy property. REITs is you're basically buying a share of this investment trust that focuses on real estate, and you own a portion of that. There's a lot of REITs that own things like housing in apartment and condo complexes. There's REITs that own shopping malls. There's REITs that own data centers, where you have all the computers that run the internet. There are data centers that are then people put their computers in and the data center rents out that space. Or warehouses. There's a lot of different ways to invest in REITs. Healthcare, for example, hospitals. When you go to the hospital doesn't actually own the building. It's owned by a real estate investment trust in almost all cases. So you can invest in hospitals by owning the building as part of a large group of people. And REITs trade on like stock exchanges and stuff, so they're very liquid, as in it's easy to buy and sell. So REITs are an interesting thing because they generate a lot of income, a lot more income than even a lot of dividend stocks. A little more risky than bonds would be, but it's a way to generate that income. So take a look at REITs. Another one is MLPs, managed limited partnerships. Basically they act the same way as REITs as far as being able to buy and sell on stock exchanges or in other ways, and it generates a lot more income than bonds, and a little bit more risk for that. But instead of owning real estate, it's more oriented towards around things like gas pipelines and energy sector and all that as far as owning the pipeline. So you don't own the gas, you don't own the oil, you own the pipeline that's running through. And there's companies that are involved in managed limited partnerships where they generate more income by investing in those types of properties. In fact, REITs and MLPs are both highly regulated, where they have to pay out most of their profits out as income, or in effect as dividends. So that's a way to make that middle bucket a little bit better too, but taking a little more risk. A couple other things you can do. One is delay retirement. Well, I'll tell you, I didn't have some great answers for it. First two are a little better. This one's like, you could delay retirement, and every year that you delay or every month you delay, that's giving more of your income time to your investments to work. They keep working. Plus you're earning a salary or whatever you're getting paid from your job that's helping to cover your expenses. So you're not having to draw out of your investments to start covering expenses. So you can always delay a retirement. You could adjust your spending down, especially in the early years, to try to reduce your spending just to make it a little safer. Again, that's always a trade-off, right? Wouldn't you rather, maybe travel or do some fun things in your early years of retirement where you might have some, be able to do that better physically than if, let's say, you're 90 years old. Maybe you're only, 40, 50, 60, 65, 70 years old, so you're able to enjoy retirement better, but it's something you can do as far as really watching your spending in those early years. Again, you're letting your investments have more time to grow as far as that. Another thing you can do too, just suggestion, is to take on a side gig or a part-time job. That was one thing that helped me make the bridge to my own financial independence, was like, I can teach investing, right? And maybe make a couple bucks. I thought, I'll make a couple bucks and a little bit of money, and they'll help to kind of smooth things out just in case things happen weird with the markets, and it's fun to do. Now, I didn't expect that the thing was going to take off, and I have lots of students from all over the world, hundreds of thousands of students actually. It's just crazy. And so it's become much more than that. and which is helping me, of course, in my own financial independence. Now, you could do that too, and it doesn't have to be some big thing, but do something that you enjoy, just something you enjoy doing, and maybe it's a part-time job or it's a side gig job, maybe driving for Uber or Lyft, whatever it might be. Having just a little income coming in can really help a long way without going back to full-time work and all that. The idea when you get to that point is you want to enjoy the golden years of your life, depending on whenever you start that, whether it's young or older. You want to enjoy that time. You don't want to have a full-time job, but taking on a side gig or a part-time job can help let your investments grow over time, and especially if you're using a bucket of monies approach or any of the retirement approaches type things, ways that you can look at things. So with that, you can see if interest rates are high and inflation was low, then that's the best of both worlds, right? Because our short-term and our medium-term buckets are generating a lot of income and we're not having to pay out a lot of expenses. But that's really unusual. It's more a matter of helping to match them up a little bit better, your income from your investments and inflation, kind of keeping those together with your growth portfolio part of it, growing bigger, and each bucket filling each other. Remember where you had each bucket filling each other? But right now, when interest rates are low, these are some of the things to consider as far as managing risk, taking on a little more risk, better income generators, maybe delaying retirement or adjusting your spending down, or taking on a side gig or part-time job. Different ideas that you can do. So think through all this. Think through the bucket of monies approach that we've covered here. See if that's a right fit for you. Kind of plan it out. Look at what you've got in your total nest egg and what you might need to fill those buckets and how that might work for you as well too. So if you got a comment or thoughts on that, or if you're already using this approach and you want to share some advice for others, put it in the comments below. If you love this video, give it a good like here. Certainly follow us and subscribe. We'd love to have you do that. With that, I wish you all the best of luck in your investment journey, and whether you're using buckets of money or another approach, I know you can do it, and I'm rooting for you out there. So with that, we'll wrap up this video, and I wish you all the very best.